Okay, welcome back everyone. Michael and Katrina here with STR Wealth Academy, where we show you how to turn short-term rentals into long-term wealth.
Yeah, so today's topic is something we get asked so many times, and we thought we would just do a video for reference and just like dive into this topic of how much does it cost to start a short-term rental business in 2024.
This is like probably the number
Number
one.
one.
We get this like multiple times a day. It's like, how much does it actually cost to get this business going?
Mhm.
So what we want to do in this video is kind of take you through the different options that are available to someone that is looking to get this business started, so you can plan properly of what you actually need to get this going. Okay. Now, if you first time to the channel, welcome. We started this journey about 6 years ago now, built our portfolio up to over 65 units, have personally done over $10 million in this industry. If you're wondering who the hell are you guys and why should we listen to anything you have to say? So
Yeah, and we've been coaching for over 4 years.
Yeah.
We've helped hundreds and hundreds of students leave their 9 to 5, retire spouses, hit their goals of traveling the world, being able to create a financially stable short-term rental business. Just like we said, creating short-term rentals, but long-term wealth.
So let's dive into it. So the question, of course, is how much does it actually cost to get this going? So the answer is it depends. And what we mean specifically by this is that it really depends on the kind of business model that you pursue. Now, there's a lot of different terms that get thrown around in our industry. People try to make it more complicated than it really actually is, but it actually just really boils down to 3 different options. Okay, so we're going to run through those with you and give you some ranges of what you can expect to invest in order to get this opportunity up and off the ground and going.
So really, it comes down to 3 short-term rental business models and different profit models that you can do. So the first one, and most people would know this, is actually owning your own short-term rental property. So that's actually buying the property. So this obviously is the most costly model to start, but it also has the greatest potential to build long-term wealth because you're actually purchasing the property. So the common phrase, 90% of millionaires in North America have either made or hold their money in real estate. This is very important. So
that's what you might call a clue, by the way.
Right. So there's some great pros with this model. With owning your own short-term rental is really, it allows you to build equity within each payment that you have. The asset can appreciate in value over time as well. And there's multiple tax benefits through depreciation, cost segregation studies to accelerate your depreciation allowance. And it allows you to be a little bit more creative with your design and amenities. And you call the shots when you actually own the property. You don't have to go through permission of a homeowner or a property manager.
Yeah, there's a lot of benefits to owning a property because you don't have to get approval from someone to be like, hey, we want to do this cool feature wall, or hey, we want to spend this to have this amenity here.
Paint this wall, knock out a wall, do something really cool in the backyard.
Renovations, upgrades, all that fun stuff. That'll be another video. But there's definitely some cons to owning and buying, okay? And we'll run through those really quickly here. The biggest con, of course, is that if you're looking to get this business started, it's by far and away the most capital intensive model in this industry, because quite simply, well, if you have to come up with a down payment and then you have to pay for furnishings, and then if you're also doing upgrades or renovations, trust us, it can get very expensive very quickly. Now, personally, at the time that this is being recorded, we own 6 of our own properties and have grown that portfolio as we've been in this industry over time.
Just reinvesting within our own business, and all these models that we're talking about today, we do them all as well. So we have a bit of experience in each one of them. So this is the highest barrier of entry to get into, right? If you're doing that high capital intensity to get into this model. So I mean, that's good in a way that like not a lot of people will own and do short-term rentals with it, but it is capital intensive.
Yeah, and because of this dynamic, it makes this model in particular hard to scale, simply because, well, it just takes a lot of resources. And I don't know about you guys, but if you've been paying attention over the last like 4 years in particular, ever since the pandemic, prices have just gone like
bananas.
Groceries and gas aside, like the price of housing has just gone absolutely crazy, both in the United States and we're located in Canada. It's been just like parabolic in a lot of places. So,
and it also takes up your credit as well. So the scalability is a little bit harder to scale because of the, cash intensive and also the credit suck on it as well.
Totally. Yeah. So because of this as well, when you actually own the property, there tends to be a little bit higher risk with this too. Now, you can mitigate a lot of risk by obviously buying in the right location, buying in places that are STR friendly from a regulatory standpoint and, good local ordinance bylaws, all that fun stuff. The issue though is that if the rules ever change in the area that you own the asset, you could potentially be holding a liability pretty quickly, because if it prohibits your ability to operate that property as a short-term rental, well, it can be a little tricky to wiggle out of a mortgage. So pro tip, just as a little bonus here, if you are going to get into buying a property for the purposes of short-term rentals, you have to make sure that it will also make money as a long-term rental as well, okay? So you don't want to just simply do what we call short-term rental math, meaning that like I have to be 95% occupied at $500 a night just to break even. That doesn't pan out, then you're going to be essentially holding the bag, okay?
Yeah. So really getting into more of the topic of what it really does cost to start, owning your own property. It really varies and depends. The amount needed to start, could be in the 10 to hundreds of thousands of dollars, depending on how much money you need to put down, the regulations, the requirements, the different areas, the different markets. We've been in a market where we literally needed to put down almost up to 50%.
It was 50%.
It was crazy. And that was because of the risk behind short-term rentals, and a lot of mortgages and banks, especially up here in Canada, are saying, no, it's riskier. You have to put a higher down payment. So you got to be aware of those, but that's one of our most profitable properties as well. So you really got to weigh the pros and cons.
So that's the most costly way to get started, is actually owning the asset. Okay. So now if you're a beginner and you feel deflated, stick around, because we have good news for you. We're actually going to go through a lot of different ways that you can get involved in this with way less capital investment up front. Okay. But if you're liking the video so far and you're enjoying the content, please make sure you like, subscribe, and hit that notification bell on the channel. It helps the algorithm to let us know that you're enjoying what you're seeing here, and it pushes our content out to a wider audience.
All right.
Let's dive back into it.
Okay, guys, so that is model number one. Let's dive into the second model of how to get into short-term rentals and the cost behind it. So short-term rentals are not new, been around for quite a number of years here, but how to actually get in without owning property. This is maybe an aha moment for you. Be like, you can get into Airbnbs and short-term rentals without owning any property.
You can.
You can. And let's dive into those options, and they are less costly to get in and less barrier of entries as well. So this is what we call model number two, rental arbitrage.
Sometimes this is called master leasing. Sometimes this is called the rent to rent model. Essentially what's happening here is, rather than you buying a property and potentially having a mortgage with the bank and all those various things, what you're actually doing is you're renting a property from a landlord or a homeowner as if you were a long-term tenant, and then you're turning that property around, furnishing it, and then listing it on the various short-term rental platforms. Okay?
Yeah. So instead of a long-term rental where you have it, by the month, this is by the day that you're collecting that money. But the thing is, to make it profitable, you need to make sure what you're collecting by the day outperforms what you'd be collecting as a monthly rent.
That's where the arbitrage piece comes in. Okay. So it's basically you're profiting on the discrepancy of what you can charge daily versus what you're paying monthly. It's actually the same business model as rental car companies. It's just applied to real estate.
Applied to real estate.
Yeah. So, they lease cars from the OEM manufacturers and they sell it to you on a daily basis. It's the same idea here. Okay?
So there's some great pros to this approach. It is much less capital intensive getting into this, because you don't need a large down payment and you can scale much faster. It's not taking up your credit. You're able to sign as many leases as you can. There is some risk and cost still with it. So the cons are that you still will need first month rent typically as a damage deposit that you need. And you can also have to pay potentially for furnishings. There are furnished rentals out there. Typically, they're pretty sparse when you see that. But the thing is when you do those furnishings, it's much less than you would for a down payment on the property. So it is easier to get into. And a lot of people are like, who would actually allow, what landlord would actually allow you to do this? Guys, this is a huge need in there. You're still doing professional cleans, handyman. We have an entire video on how to get into these type of properties, how to have conversations with landlords, and to actually sign these types of deals.
Yeah, and if you want some advice on how we approach those conversations, we'll make a separate video here on the channel and we can talk about that in another video. But in terms of what it costs to get this going, again, it depends on a few factors. It depends on how large the property is, what market you're in, how you're outfitting, and what amenities that you're offering to your guests. But if you're new, our general recommendation is you should have at least $10,000 to $15,000 set aside for this model. Could you do it with less? You could, if you're really hustling and you're buying things secondhand. It's funny because that's actually how we started.
That's how we started. It is one of the easiest way to get into building your own Airbnb short-term rental portfolio by managing via rental arbitrage. It is because you're still feeling that homeowner's need of renting the property. That's what they're looking for with all the additional benefits, the professional cleans, the minor maintenance. So that is actually a win-win in that situation.
So if you think about that startup cost versus actually owning the asset, one down payment on one property, that could finance probably between like 3 to maybe 5 to maybe 7 rental arbitrage deals. Okay. So if you're a person that has some capital set aside and you're looking to figure out what to do, this could be a really great way to get your business started so that you can start earning cash flow. So then you can take the money that you're making, either keep reinvesting in arbitrage or save up enough money to then potentially start purchasing the asset.
And there is a little bit additional pros and cons, I would say, with this. So let's say regulations do change in a market. It is a lot easier to get out of a lease than a mortgage. So that is actually a pro. So exiting a deal is a lot easier than a mortgage. But there's also the con because you are sometimes signing maybe just a 1 or 2 year lease and you're purchasing those furnishings when the landlord, let's say they want to sell or they don't want to rent to you anymore. At the end of the day, you just have to move the furnishings to a new unit. But you do have that carrying cost of furnishings now and having to move it.
It's what you might call a pain in the ass sometimes. Okay.
So let's be honest.
It's not impossible. It's just, you set aside a weekend or you get some people to help you out. But there are some, obviously with any model, there's going to be pros and cons to everything. Okay. But in terms of what it costs to get this model for short-term rentals going, far less costly than actually owning the asset and much more scalable.
Yeah.
Okay?
All right. So this leads us to number 3. And this is one of our absolute favorite models. It is what I would say one of the most models we're actually known for with STR Wealth Academy. I think our portfolio, we have about 70% of our portfolio is this model. So that is another hint here, guys, something we love. And let's dive into it.
Actually, I'll give you a little bit of backstory before we dive into this. So when Katrina and I started this business, we started with rental arbitrage. Okay. So we were signing leases, we were getting furnishings, we were getting the units going, and it was going fairly well in the beginning. But what happened was we got to around, I think, 5 units, and then we ran into the situation where we simply ran out of capital to expand.
We said we want to grow, we want to expand, but essentially we ran out of money. And because it is the furnishing costs up front, some damage deposits we had to pay, and we were also paying leases at that time too, rental a month.
So although we were profitable, we were profiting several $1,000s per unit and we were collecting this money, it's still for us, probably just because I'm a very impatient person, it just felt too slow.
Yeah.
Okay.
We wanted to go quicker. We wanted to scale a lot quicker as well.
So we asked the question, well, what if we actually didn't have to do any of this? What if we didn't have to buy furnishings? What if we didn't even have to have a lease? What if we could just get into deals for no money down? Seemed like a crazy question at the time.
We just had a meeting. It's like, what if we didn't have to pay for furnishings, pay for utilities? We didn't have to pay for any of this and we could just manage.
Yeah.
This is where we came into our third and one of our most favorite models that obviously we utilize the most at 70% of our portfolio is our proprietary partnership model.
So we call this the partnership strategy. So essentially what's happening here is you're essentially signing a deal with the homeowner where they are setting the property up as a short-term rental. So they are paying for the furnishings, they are paying for the startup costs, and they want to get involved in the space, but they just don't want to do any of the work. They don't want to manage, they don't want to take care of guests, they don't want to do any of the cleaning, they don't want to have to coordinate any maintenance. They want someone else to do that work for them, and in exchange for that, you get to earn a percentage of the revenue that gets produced on that property. So what's really unique about this is that on the business end of things, you can literally pick up properties for no money down because you're not having a lease, you don't have a deposit, you have no furnishings, you don't have a down payment because, again, that's all being taken care of by the person that actually owns the unit or the property.
This is like legitimately, you do not need to put a single dollar into this. The homeowner's responsibility is all the utility, furnishings, everything of the property. You are literally taking a cut off of the top line bookings coming in for your services of everything else, making sure, just like Michael said, the guests, coordinating the handyman, everything from there, and you're just taking a cut of the fee.
Exactly. So this is how we grew our business as quickly as we did. As soon as we figured this out, we went to like 10 listings, 20 listings, 30 listings, and now on to, like we said earlier, like 65 listings, and we're still growing, expanding, and scaling. So
this is massive, guys. This is a huge pro because obviously getting into properties with zero money down and starting to make money month one, you're in the black, you're in the profit is incredible.
That's another good point, because since you actually don't have money in these deals, well, as Katrina said, it's actually an infinite return on investment because, well, you have no investment in
You
it.
can't go negative on
Yeah.
this. So when they said, oh, say, is there any actual risk with this? Yes, there's reputational risk. You have to
Yes.
perform for the homeowner, else they will not keep you around.
Exactly. So the other thing with this as well is, as you start onboarding clients, you're going to work with a lot of different kinds of people, okay? And over the years, we've had a lot of varied experiences, you could say, on this. And the thing is, some people can be extremely emotional about their property for a lot of reasons, legitimate concerns, definitely. But sometimes you run into situations where homeowners have absolutely wild, unfounded expectations on what they think,
Yes.
what they believe their property can make. So your job as the manager is you really need to work with coaching your client and bring them into reality of what is actually possible for their property. Because a lot of the time you might run into people that think, well, my house should be making $500 a night. I'm like, wonderful. Where are you getting that figure from though, exactly? Well, that's just what I think it should make, because
What I
it's,
feel and I think it should make, because it's such a beautiful house. Is it in a great neighborhood?
yeah.
Does it have great amenities, right? Do you have a marketing strategy? Do you have a revenue management strategy? There's so many things around it. So when we're looking at this, guys, when I said the downside of this as well is reputational risk, this is huge.
Yeah.
You need to know what you're doing.
Yeah.
You need to be able to maximize profits, have a pricing strategy, an optimization strategy. You need to be on multiple platforms, have the proper software systems. Team members, you have to make sure your cleaning's dialed in, your handyman's dialed in. You have to know how to make sure that property is going to sell. Like, people actually want that product.
And they want to stay there. Yeah. So, and this is a big responsibility. Initially, it sounds extremely enticing. Hey, I can get paid on properties I don't own. I don't have to put any money into them. But this is like, you're essentially the steward over someone else's asset. That's a big responsibility.
Yes.
So how the property looks, how the property is maintained, that all falls on you. And that's why they're hiring you and they're paying you that fee. Okay. They're not just going to do that out of the goodness of their heart. Okay.
Yeah.
So we're in upcoming videos, we'll get into a lot more details of how you can actually manage these types of relationships, how you can actually get clients following that model. But in terms of most expensive to least expensive, that's essentially the hierarchy. Okay. So obviously, just to sum all this up, owning the asset, our light was just about to fall over there, by the way.
We're just like, ah.
So owning the asset, of course, is going to be the most expensive. Okay. That doesn't take a lot of thinking power to understand why that is. Okay. The next lower barrier to entry is going to be arbitrage. Now, again, you're probably going to have to plan between probably $10,000 to $15,000. I see some influencers online saying you can do it for $7,000. Bullshit. I haven't seen it personally.
Yeah, and it depends. Like, that's sweat equity as
Yeah.
well, right? Like, and you got to always see what's under the hood when you're looking into that, and you got to see what you're purchasing, right? You have to have quality furnishings. You could have, like, really unfortunate crap quality, and it's going to break within weeks.
Yeah, we like to say buy it right, don't buy it twice.
Yes.
Okay. Now, furnishings, obviously, that's a whole other topic, which we can do in future videos. So again, owning is going to be most expensive. Arbitrage is going to be a lot less, but then partnerships is obviously going to be the least expensive, potentially no cost way of getting into this. Now, if you're a beginner, you might be wondering, which one do you recommend that I start on? And the answer is, it also depends on your situation. Okay. It depends on your goals. It depends on your risk tolerance. It depends on like what you're actually trying to achieve here.
And depends on the opportunities. If you have an incredible opportunity to own a vacation rental and you go through a mentorship, go through a training, you're able to run the numbers, let the numbers speak for the deal. However, let's get into it high level right now. If you're a complete beginner, our recommendation typically to our STR Wealth Academy students or anyone coming on board, we honestly usually start with rental arbitrage. It is one of the easiest ways and simplest models to get into this, because if you're pitching a prospective landlord or homeowner, it's what they want anyways. You are technically a tenant, and it's what they're looking for anyways. So you're just pairing up with the additional benefits.
Yeah. So usually what we recommend, you start this way for the first maybe 2 to 3 deals, get some experience under your belt, understand the business, understand the operations, understand, the day-to-day and how all that works. Then once you see what kind of numbers you can produce on a property, then you can then leverage that experience and then actually present something that's compelling to a homeowner. That being said, If you're super motivated and you develop the skill of sales, which we talk about extensively in our training, you can absolutely start on partnerships and co-hosting and all those things. And we've had lots of students do it, but large majority of cases, this is by far the way the easiest way to get started, because it's the easiest thing to explain to someone.
Proof's in the pudding. Once you have the numbers, you have some experience, you have your systems, your team, everything set up, it really is easier to scale with partnerships from there. And then honestly, once you have really good rental arbitrage, partnership models, if you wanted to, and this is your goal, and you have enough cash flow coming in, you can start just like what we did. And a lot of our students start reinvesting and they start buying properties and acquiring properties, and they start building that long-term wealth. So again, utilizing short-term rentals for long-term wealth. This is exactly what we did, quite a number of our students, and it's an incredible business model, definitely sustainable, and is not going anywhere soon.
Not even close. Cool. So hopefully you enjoyed this video and got some value out of it. Again, if this is the first time to the channel, welcome. Go ahead, like, subscribe, and hit that notification bell so you get made aware anytime we release new content on this channel. If you have any questions or if you want more details on how this all works, go ahead, drop us a comment in the box below, and we will see you guys in the next video.
See you there.
Take care.